I should be live on YouTube, and I should be live on the virtual trading floor here. Just see something. Ooh, that works. If anybody can confirm for me on YouTube, just because I'm doing a new technology here, I want to make sure it works. Sweet. Oh, how exciting. Wish I had known this a long time ago. Alright. Let's jump right into the disclosure, because I always have to go through this if I'm live streaming outside the virtual trading floor. I'm an associate member of T3 Trading Group, which is an SEC registered broker, dealer, and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Here is my position disclosure, a lot less longs. Pat just posted the YouTube link there a moment ago. Alright, let's go to the charts. First, I just want to do something here and see if that works properly. Alright, I think that works. Anybody has any issues with my technology, whether it's through YouTube or through the VTF, definitely let me know. Because like I said, I'm trying something new here today. And obviously the purpose is to give you guys a better user experience. And if not, I can always revert back. I'm going to bring this down a little bit. Awesome, awesome. Thanks, guys. All right, so, wow, what a day. Let's jump into it. Well, ladies and gentlemen, here's your official announcement. The S&P 500 is officially in a bear market. Yeah, I got the, it's a weird sun coming through this window. I'll try to fix that one for tomorrow, one step at a time. Anyway, like I was saying, we are officially in a bear market. There's your announcement. This is not a new thing, really, to any of us, because we've been in a bear market for a while. Thanks, Mike. We've been in a bear market for a while. You can... There's a bunch of different things that we can point to here on where the top is, if you will. In a lot of ways, you can't see it in the S&P, but in a lot of ways, the top was February, March of 2021. That is when growth stocks peaked. I don't know, pick your favorite growth stock. I just typed up Palantir because it's one of my least favorite. I was actually ruthlessly short this Palantir at one point, and I had to blow myself out of the position. I think in the low 30s on this day. I was heavy short, and then they had this final short squeeze, and I couldn't keep it. But this was the bubble move. You had all these garbage companies, and that's what I was telling everybody back here. I was like, Palantir's a garbage company. But you know what? It doesn't matter if it's a garbage company. The technicals are the most important thing. Because thank God I blew myself out in the low 30s. Because if I had held this against me to 45... Maybe it doesn't even stop at 45. Maybe it stops at 75. Look at what AMC did. It would have been really bad. So it's one thing to have a thesis. I had a thesis. Palantir, terrible company. I want to be short it. But if you don't have the technical confirmation, you got to stop yourself out of your trades. Or better yet, don't execute them if you don't have the technical confirmation. So in a lot of ways, the real top of the market, this is when the bubble burst, was February, March 21. And most of those types of stocks that went up over the course of just a handful of months here, and there was a lot of them. I've never seen anything like this, by the way, in my entire career on the upside. I've seen, your garbage meme stock, that's what we call them these days, or short squeeze stock or whatever, just a garbage company. I've seen them go up. I'm not sure, Patrick, I assume it's just ProDesk. I've seen them go up 200% before in short periods of times, but I had never seen this many companies do it at once. 200%, 300%, 400%, 500% over the course of just a few months. And then we peaked out, and that was it. Now, these companies, depending on which one you look at, most of them are down somewhere between 75 and 90%. And that actually potentially begins to create opportunities in the other side. Pat had a note in one of his morning notes from last week that showed a chart of like growth stocks going back to, I think it was 1996, on their price to sales ratios, and we're actually now like one standard deviation below the norm, below the average, going back to 1996. I thought that was a very telling chart, because where I'm at with a lot of these growth stocks now is some of them are at prices where they belong. I actually don't think Palantir's is zero. As much as I dislike this company and they have not been able to be profitable for 20 years of existence or whatever it is, this one I actually don't think is a zero. I also don't think it's a good company. I don't want to be long it. There's others that probably are zeros, and there's others where they're down 90% and they're probably real companies. And in a lot of ways, it's a stock picker's market. The technicals will confirm it, and that's a lot of actually what I'm starting to look for at these prices now. But anyway, I don't want to get off topic right now. We're talking about when the top of the market was, right? Next big thing, our next great spot where you can say the top of the market is November 21. The IWM, I can't emphasize this enough, and today was a perfect example of it. On multiple time frames, even as small as 5-minute charts, the IWM, the Russell, has been the consistent leader. There have been so many days, intraday, where the S&P looks fine, the NASDAQ looks fine, and then you look at the IWM and you go, uh-oh, IWM's not looking right. And then because of the IWM weakness, the S&P and the NASDAQ eventually roll over. And the opposite too, right? The way that we were kind of able to capture this rally into the second half of May was because the IWM created a higher low here when the S&P and the NASDAQ were making new lows. And they were still holding up above this 175 support. And then again, even today, we're asking ourselves, what's the price action going to look like off the open when we're having a massive gap down into support in an extended market? There was a chance, I know someone said that they were looking for price action similar to February 24th, and I talked a little bit on the radio today about why today was different. But there was a chance, I don't know if it would be to this degree, that we would see a real strong opening rally because of where we were gapping to and how extended we were. There was a chance that that would happen. But then your opening low has to hold. And SPYs here, second bar, they're still kind of holding. Qs here, second bar, they're still kind of holding. And as a matter of fact, the SPYs and the Qs had a 35-minute price correction here, which I'll get back to in a second. What was the real signal, though, that we weren't going to get that rip higher? What was the real signal that we were actually going to break down? Was once again the Russell. Look at this IWM trash can of a market. Just like, so bad. So bad. Awesome stuff, TH. So bad. First candle tries, immediate second candle, full negation. Look at this selling here. You didn't even get a test of the ADMA on the 5-minute chart until 11 o'clock. So bad. This was the signal today. So, in a lot of ways, if you don't want to use the growth top of February, March 21 as the top of the market, the IWM, the leader here, that was it. And this was a false breakout. I remember as a team here, we kept talking about this 230 to 233 resistance area. It broke out in early November. Like, wow, I remember saying, I can't believe this is going to be happening. We're going to be raising interest rates soon. And then it was, over the course of 1 month, it was a failed breakout. From a failed breakout, oftentimes come a fast move. That fast move was started by this gap, breakaway gap, basically to the downside here. And then all this money was trapped, and the IWM had been weak ever since. But because of the S&P and the NASDAQ being weighted the way that they are, with Apple holding up so well for most of the beginning of this year, Microsoft holding up so well at the beginning of this year, you did not see an actual top in the S&P and the NASDAQ, especially the S&P, until the very beginning of this year, until basically January 1st, in a lot of ways was the top. And then, you know, the rest here is kind of history. I'm not going to get into too much detail on it. So that's really where the top of the market is. So I guess today we are officially a bear market for the S&P. Congratulations, S&P, for telling us something that we already know. Half of the NASDAQ companies, half of them, are down more than 50%. That's not a bear market. That's like a depression. It's getting real bad out there. And I'll tell you, This price action, now let's talk a little bit about our current times here. Oh my God, these last 3 days. Look at the move on these last 3 days. And not on massive volume. That's concerning, right? I want this volume to be bigger at these prices, and it's still not. There was no capitulation. Exactly, Trader Mike. There was no capitulation today at all. We haven't seen capitulation all year, except for maybe a little bit on May 24th off of Snapchat in the first hour and a half of the day. There's been no downside capitulation. That's what everyone was talking about. No one was looking for this rally in the second half of May, except us, to be honest. People were looking for a bear market rally earlier, but then it failed. No one was looking for it in the second half of May. This is when all the big bank analysts were getting more bearish, talking about 340 in the SPYs, 360 in the SPYs, and maybe we're still going to go there. But we can't rally now. There's been no capitulation in the market. So when they wanted capitulation, they didn't get it. When they didn't want to rally, they got it. Now maybe we'll start to, at some point, if we get another couple down days like this, then we will see capitulation. It's the way we're selling here is getting scary, because even if you look at the biggest declines that we've had this year, if you look at the decline we had in January or the decline that we had in February, both leading into great extension lows here, it would like the vertical nature of this sell-off here is breakdown, close on lows, gap and go to the downside, gap and go to the downside. Like wow. And you type up some of these charts, like what Apple just did, what Amazon just did. Oh boy. What the Qs just did, the way we're selling here, it's getting wild. So we got to pay attention to the same stuff that we always pay attention to, though. We have to pay attention to our extension rules, understand how the market dynamics work. We got to pay attention to what the market sentiment looks like. And we got to pay attention to things like the Fed and interest rates and how it affects the market. The market is extremely fearful right now. Wednesday's a real wild card, though, I got to say, at this point. Like, if we didn't have the Fed on Wednesday, I would really be itching tomorrow for like a red dog reversal, Oldensmith overthrow, or gap down that we could buy up, some sort of situation like that tomorrow. But I'm not sure we're fully there yet, though we have massive downside extension. The massive downside extension makes it very difficult to short, even today, except for just maybe a day trade or a momentum scalp. Otherwise, if you're big picture on the market, which everything I do, even from a day trading perspective, starts big picture and works its way down, I prefer to trade, even if I'm pure day trading, based on what the daily chart is telling me. Because if I'm trading based on what the daily chart is telling me, I'm going to have a higher probability of success in smaller time frame trades that I take. And what the daily chart here is telling me is, yeah, we could go down if there's momentum, we could go down further, but it's very hard to actually be short based on the big picture when you're this extended. So the way that I like to look at extension, just to review for the new people here, and there's a lot of ways that you can look at extension. There's a lot of indicators and oscillators that you can look at, and I do pay attention to that stuff. For me, it's very simple. My charts are very simple. I like to look at Japanese candlesticks, volume, and a couple important moving averages to me. I look at an 8 and 21 EMA on every time frame. And on daily charts, I also like to look at 250 and 200 SMAs. But the 8 and 21, that's the most important thing to me. I don't think that moving averages are support or resistance. I don't treat them that way. They're just squiggly lines. They're just averages. They're just tools. And as a matter of fact, any indicator that you think about, whether it's DeMarks that Diego loves to use, or Pat likes to use Bollinger Bands and Ichimoto clouds in his morning note that he does every day, all of them indicate something. That's why they're called indicators. They're not the end-all, be-all. So they might indicate that the market should bounce, but it doesn't have to bounce. A market can remain irrational longer than you can remain solvent. But when you got those indicators lining up, or your moving averages are giving you a piece of information, that's when you look for your actual trade setup to come into the marketplace. So the way that I like to use the 8 and 21 EMA is as a tool to show me equilibrium. I consider the space between the 8 and 21 EMA to be the equilibrium zone for the market. And if a market moves away from the 8 and 21 EMA, like it has now as an extreme example, or even if it's moved away from it a little bit, like to the upside on the close on June 7th, just a handful of days ago, even though 416 in the SPYs feels like an eternity ago, that was just 5 days ago. Just 5 days ago, we were actually slightly, so you can have degrees of extension. We were slightly extended to the upside. The right way to really do this is to really just do it with math on percentages. Like we are extended away from the 8 EMA by 3%, by 5%, by 20%, whatever it is. And then you can understand your degree of extension. Hard to do all that percentage math super quick in my head, so I can just tell relatively. So for the SPYs here on June 7th, the high was $416 roughly. The ADMA was at $4.11. $411. So we were roughly extended in the SPYs by $5 to the upside. Yes, TH15. That's exactly what I'm trying to get across to you guys. Right now, we are at 375, let's just call it, with the ADMA at 398. So we are $23 extended to the downside on the S&P. This is some of the most extended I've ever seen the market. Individual stocks, you have to know the stock you're trading, right? Certain stocks that are higher beta, they're more volatile, they can become more extended. Other things, like your consumer staples tend to not get that same degree of extension. The S&P, being a broad index, tends to not have very, very large degrees of extension. So it's relative, and you want to understand the product that you're trading. But this right here, which is funny because it's already happened a couple other times this year, is one of the most extended, by the way that I like to view the market. It's one of the most extended I've ever seen the S&P. And interestingly enough, we are not as extended as we were on the low on January 24th. This might be actually the most extended we've been on a closing basis. This might be the most extended we've been on a closing basis. Not the most extended on an absolute basis. We were more extended on January 24th, and we were about the same on February 24th. So, like what you were just saying here, TH15, markets have to gravitate in one way or another to this equilibrium zone, the space between the 8 and 21 EMA. It doesn't have to be that the market gravitates to it. It could be that those moving averages gravitate to the market, or a combination of both. And that's what we call a correction. So when a market gets extended, here's extension rules. This is how extension works in the marketplace. The first thing that you need to know about an extended market is that it can become more extended. You should never think to yourself like, oh my God, Derrick just said that the S&P is the most extended he's ever seen on his career on a closing basis, so I need to buy. Nope, don't say that to yourself. Because next thing you know, we're at SPY 350 after the Fed meeting or whatever, and we're even more extended. Or maybe it's even tomorrow, the way we've been selling off. So a market that's extended can always become more extended. That happens particularly when there is news, heavy volume, or a tremendous amount of emotion in the market. It's really like one of those three things that can enable an extended market to become more extended. Because the only way an extended market becomes more extended is through momentum. The whole concept of momentum shouldn't exist if you believe in the efficient market hypothesis. The definition of momentum, and guys, there's 3 definitions for people who are new. There are 3 definitions that are the basis of my entire trading system. The definition of a trade, the definition of trend, and the definition of momentum. Let's just focus on number 3 right here because that's what we're talking about, the definition of momentum. The definition of momentum, and this really applies on the upside, it just put it in reverse on the downside. The definition of momentum on the upside is the greater the price, the greater the demand. So I guess the definition of momentum on the downside would be the lower the price, the more people want to sell. That's the opposite of the way a typical marketplace should work, right? I don't know, if you were in the market to go buy a new suit for yourself, and I said, hey, every suit at my store is $5,000, you might be like, ooh, a little bit out of my price range. But if I was like, hey, I'm selling $5,000 suits, they were $5,000 for $500, you might go, I'll take 2 of those, right? The lower the price, the more demand that's going to come from it. That's the way markets are supposed to work. But not in the actual marketplace, the stock marketplace, where there are human beings and there's so much emotion. And that's actually what creates trading opportunities. So a market that's extended can always become more extended because of these emotions, fear and greed, right? The definition of momentum, the greater the price, the greater the demand, or in this case, it's the opposite. The lower the price, the more people want to rush for the exits and get out. So you can't just come in and say, wow, Derrick's saying this is the most extended market he's ever seen. I got to come in and buy. But what you should be saying to yourself is, this is the most extended market that Derrick's ever seen. Should I be pressing my short sell button? Should I be panicking out of longs? You should follow your game plan in longs that you already have on. That's what you should be doing. But for as far as new positions go, you want to short in the most extended market that I've ever seen? And honestly, the answer is maybe. Depends on the time frame of the trade. Because if you're shorting here, you are only going to make money really based on continued momentum. But who cares how you're making money if you're making money, right? But you got to recognize the type of trade that you're taking. So if you're putting shorts on right now, they should be tight risk, small time frame trades. And that's not really my game. I'm seeing Diego here saying that's not his game either. I don't like the idea of buying markets that are massively extended to the upside. I don't really like the idea of shorting markets that are massively extended to the downside. I prefer at a certain point to look the opposite direction, but you got to be very careful going the opposite direction. Because what's the problem with coming in and buying this morning or tomorrow morning if we open up the same spot we do today, is if there is panic, if people are stampeding to the exits. Maybe you're right, we're extended to the downside and a bounce has to come in, but maybe we need to panic for $15 more to the downside before the bid actually comes in the marketplace. We still haven't seen that real panic coming in, and that's the one thing that keeps making me nervous. I want the panic selling to come in. The panic selling, and it doesn't have to happen, but I've seen panic selling mark the low of bear markets before in my career. And we have seen little to no panic selling in this environment. Granted, markets are always changing. Not every bottom is the same. The algorithms become more intelligent. And honestly, even retail money, I truly do think even retail money has gotten more intelligent than it used to be. People who are just investors who have learned about the concept of dollar cost averaging. If you're 30 years old and you have a job working for Verizon and you want to grow and build wealth, you should be excited because you can buy more of good companies at cheaper prices. And I think that populace is more educated than it used to be, provided that they're not in meme stocks. So not every bottom has to end in a capitulation bottom, though at this type of point I would love to see it because that would create a great buy setup. So we'll see if it happens. But that's, so anyway, sorry, I didn't even get to the final point. So as far as an extended market goes, first thing we need to know, for the reasons I just discussed, is an extended market can become more extended. We could easily sell off more. But eventually, all extended markets will have to correct. There are 2 ways in which a market can correct: time and price. A price correction is when the market snaps back to equilibrium. So the market snaps back to equilibrium. So right now, if the S&P were to do a perfect price correction tomorrow, then the S&P would trade back to $398. To be fair, the 80-MA will probably be a little bit low tomorrow. Let's call it $396. That'd be a massive, massive price correction. I'm not expecting that. But that's what a full price correction would be. The other thing is a time correction. A time correction is a flag pattern. If you know any technical patterns, if you know bull flags and bear flags, all a bull flag and a bear flag is a time correction. A bear flag here would be the market stops going down over the course of the next couple of days. Forget about the Fed meeting for a minute. and we range between 378 and, let's call it, I don't know, 382 for 2 or 3, it might take 3 or 4 days because of how extended we are. And eventually this ADMA, because think about how moving averages are calculated, right? It's literally just a moving average. So tomorrow we're going to drop off the 8th day back. And because it's an exponential moving average, it weights the current bars more than it weights the older bars. So every day that we go sideways here, this 80 EMA and this 21 EMA will be catching up to price. That's the definition of what a bear flag is. Typically, bear flags continue. This is very typical. Or bull flags. Once the 80 EMA, which is that lower band of equilibrium or higher band of equilibrium in a bull market, catches up to price. So that's what we really want to see here. That's the big question as we come into the Fed meeting on Wednesday and as we have PPI tomorrow. Is, will we see further downside price action through pure momentum selling and panic? Will we see sideways price action, which is bearish continuation, bear flag setup? That'd be the worst. That'd be, in my opinion, that's the most bearish situation. And honestly, I think it's more bearish if we go sideways for the next several days than if we continue down, which sounds counterintuitive. But continuing down will be momentum panic selling. Sideways price action will be a bear flag. That's actually worse. Or maybe we price correct back up. And then when you have a price correction, there is a chance of a reversal. All reversals start as price corrections. And then maybe they actually become reversals. But probably not. Most likely what will always occur is the trend that you're looking at will continue. If you keep that as a rule for yourself and never try to pick reversals, you'll be much better off as a trader for it. And today, because of today's price action, we can actually go to our small time frames, because our small time frames confirm all of these core market principles that you want to learn to be able to implement in your trading. So what happened today? We had a huge gap down. This is a 5-minute chart. We had a huge gap down this morning. Well, what a gap does, I love gaps, by the way. Gaps are a huge part about my trading, and I'm going to be doing a class on gaps. That boot camp that Amber was talking about earlier, where I'm going to be doing, I think it's 4 Wednesdays, 2 hours each in a row here. We're going to be doing some of the classes from my training program. One of the classes I'm going to be doing is a class on gaps and how I look at them and how they influence my morning game plans. So I love gaps. Gaps give us huge trading advantages. And I hate when we have flat opens. Like, I'm going to be so annoyed if we have a flat open tomorrow. I'll be like, ugh, no gap advantage. But we had a huge gap down this morning. That's great because it's giving me all this information I can potentially absorb. When I have this big gap down today, the first question I'm asking myself in the morning meeting is, well, what is the probability of various situations occurring based on this gap, and what do I need to look for? So whenever I have a large gap, the first piece of information that I'm looking for from the market for after 9:30 is how does the market handle the gap insofar as price and time correction goes? Do we get that heavy snapback higher right off the open where we snap all the way back to these moving averages? That would be a decently bullish sign, but maybe then we get a pivot low and then new lows. That's one scenario. In that case, your opening low is very important. Opening low is very important when you get that big rally. If we lose it, that's real bear control. But that if we can snap back super strong, there's bulls out there. And then maybe they create a higher low off the opening low. The next thing you know, we get a gap fill. The next thing you know, the market's positive. That's one thing I want to see. Another scenario we discussed in the morning meeting is that we gap down this morning, we lose 380, and we have panic selling. There's going to be a recording of this afternoon meeting on the Derrick the Trader YouTube that I run, which you should subscribe to. It's new, I'm trying to build it up. Derrick the Trader YouTube. So another scenario that we discussed is panic selling off the open. I'm actually fine with panic selling. We just discussed this, but on a daily chart. I'm actually fine with panic selling, because panic selling is going to give me a super downside extension low, hammer, heavy volume, potential capitulation that I can also take advantage of. And that's actually why opening selling could be more bullish than what we had today. What we had today was what I was just describing on this daily chart of the worst situation that I would want to see if I'm bullish at all. The worst situation that I would want to see here at this degree of extension, and again, forget about the Fed meeting on Wednesday, is the market going sideways between 375 and 382 for the next 4 days. This ADMA catches up to 382, and then we have a bear flag and we break down. That's the most bearish situation. What happened today on the small time frame? We can take all this information and we can apply it to every time frame. What happened today? We had a massive gap down. What did that massive gap down do? It had a super extended on the 5-minute chart, right? Market's trading at roughly 380. ADMA when we first opens at 389. We're extended by $9 to the downside on the SPYs at the open. That's a large degree of extension. Market tries to rally here in the first 5 minutes. It can't rally. Look at the IWM. This is why the S&P and the NASDAQ, they're not going anywhere with the IWM breaking lows and then doing this. Let's go back to the SPYs because they're giving a perfect example of what a time correction looks like. So the S&P and the NASDAQ, they're trying to hold up a little bit better this morning. Why? Because the largest market weight cap stocks were holding the market up. Look at how Apple traded in the beginning of the day. Look at how Microsoft tried to trade in the beginning of the day. Look at this second bar here. I know it's an upside tail, but look at the snapback on it, right? Amazon, 2 solid opening bars here. What did Facebook do? Meta not as good. Google looking great here. Look at Google's still making highs at 945. Look what the IWM's doing at 945. Trash can market. That's one of my things I say a lot. Sometimes I throw in Oscar the Grouch memes into the VTF, and I call things trash can stocks or trash can markets. That's exactly what we had today from the Russells, a complete and utter trash can market. Google though, holding up, and this is all you need. Apple, Amazon, going into the last, I don't know if this has changed. It's probably changed a little bit. Going into the last earnings reports for Apple and Amazon, those 2 companies were 19% to the NASDAQ. So the IWM here, this is the real signal to me on the market. This is like most companies that are out there. The Qs, this is Apple and Amazon and Google and Microsoft. That's it. So they're holding up. That's enabling this market to hold up. The IWM is a real bad signal to me. And the SPYs are doing a time correction. We start with $9 of upside. Then by the second bar here, the ADMA is catching up. Now we have roughly $7 of extension. By the third 5-minute bar, on the 5-minute chart here, we've got roughly $5 of extension. By the fourth candle here, we've got roughly $4 of extension. Oh, we're losing a dollar every 5 minutes here. By the 9:50 candle, so the fifth 5-minute candle, now we've got about $3 and change of extension. We're literally losing a dollar every 5 minutes of extension. That's interesting, actually. Here we've got $2.50 of extension. Here we've got, now it slows down a little bit, right? Here we got $2 of extension. Here we got basically no extension. This ADMA catches up to these pivots. And then we can break lower. And that's why the first short that I called out today was off the 10 a.m. high. That was it. Because this market couldn't bounce. The IWM was getting thrashed. And we were no longer extended on this 5-minute chart. I remember watching this candle, right? Because when the candle is open, if there's this upside tail, that means at one point, this candle was at highs, right? Like at one point, this looked like it could close on highs. And then I watched it deteriorate. And then I saw this tail building. And before this candle even closed, as I'm seeing that this ADMA is caught up and we're really no longer extended, we just time corrected for 30 minutes. And that's when I say to you guys, all right, if anybody's looking for small time frame shorts, the timing is now. If we're going to break down, it should happen pretty much now. That's followed by an inside 5. That's actually an executionable setup for us as this ADMA catches up. We love when our bull and bear flags end with an inside candle. And this, by the way, this is a bear flag. The flag pole is the gap. The flag itself is here. When do flags usually give continuation? I just said it when we're looking at daily charts. Right when the ADMA catches up to price action. And bam. That's it. There's your first short. And probably the best short of the day. Maybe second best short of the day. Now, the next thing you want to ask yourself is, can we now have a downtrend? Is this going to lead to a downtrend? And I'm nervous. I'm nervous about trying to execute every potential pivot high on this 5-minute chart because I still have in the back of my head how extended we are on the daily chart. We're massively extended on the daily chart. When we're massively extended on the daily chart, it means that there is a lower probability of being able to have like a perfect 5-minute downtrend today and a higher probability of an intraday reversal, right? But like I was saying multiple times here, I wish it wasn't Monday, I wish it was Tuesday, I wish we had more time to digest this, then maybe we could, I would have felt a little bit more confident in an actual reversal coming in. But all the same, small time frame execution traders, I think I called out a little short for you guys here off of this candle. This is a continuation doji into the ADMA. And then this one here also, this is a continuation doji into the ADMA. You could have taken that to the short side also. And then right here at 11:10, as we started to bounce, this is a 5-minute chart that I have up right now, yes. As we started to bounce, I said, all right, I don't like the short on this one. And as a matter of fact, I think you can go long off lows. I particularly called out the Qs. I called out a long in the Qs versus lows. Lows are 276.07. I think I called it out around 276.50. It's probably like 45 cents worth of risk as a long here off of those lows. How? How did that, like, what made me think that all of a sudden this could be different? I'm calling out a short, I'm calling out a short, I'm calling out a short. Lower highs, lower lows on a 5-minute chart. What makes me think that all of a sudden this could be different? A couple things. First of all is time frames, and secondly is back to our IWM. IWM here is in this massive support area. And I've actually been talking about this area for weeks. I called out this low here because of it. Let's go back to our IWM daily, because everything we do has to start from the daily chart. IWM daily chart. Why is 170 area so important? Because of this, sure, let's talk about that in a second. Really because of this. Because of where we were in January and February 2020. Pre-COVID, the market was able to beat $170 for the IWM. Guess what? We're back to $170. So all the people, and I don't want to get into too much detail on this, there's a lot of people who keep saying this bear market can't end until the market is back to pre-COVID levels because they're taking the money out of the market. The market is back to pre-COVID levels. They're not necessarily back to pre-COVID lows, so there's more room for it to go down. We could go down to 145 in the IWM, but we are back to pre-market levels. 170 was resistance pre-market. It broke out via breakaway gap back in October 2020. That's now post-COVID. And we are now back to this massive IWM level seeing if it can hold. And again, it's loose, right? Like even this low here from November 2020, it goes down to 168.34. This low here is from March 12th is 168.90. Today's low is 169.29. So it's not like 170 on the dot. It's loose. And as a matter of fact, even though then you have a gap fill beneath that goes down to 166, I actually think that this support range goes all the way down to 160. It's very loose. But we're at what I think is a really important spot here for the IWM. And again, it's massively extended into it. This is a $181 stock, or ETF. So it's a third of the price of the S&P. And this is extended by $11 to the downside. That's a lot for the IWM. It's a lot for a market, right? So we're massively extending into support. I'm watching this area here for the IWM. And the other signal was time of day. Right now I'm just showing you guys 5-minute charts to try to show you market execution and the things that I'm trying to read. at this time of day, you have to be looking at a 15-minute chart. It's pretty rare for perfect 5-minute trends for any stock or market to last all day. Happens once in a while, but it's really pretty rare. So if you're implementing my trailing stock system, which is in my game planning class, I think I'm going to be teaching that one also as part of the Pro Desk Bootcamp that I'm doing for you guys. I don't suggest that you fully trail things on a 5-minute chart because you're going to get stopped out. Which maybe you want to get stopped out. Maybe you're like, I don't even like this position. I just got in it because Rowan was in it, and Rowan's a good trader, so I wanted to be involved with him. But I don't know. I'm just in it to go for the ride here. I just want to put the money in my pocket. I'm going to trail it on a 5-minute chart. Fine. But if you want to be in a stock all day, you got to trail it at least on the 15-minute chart. If you're looking to be a swing trader and hold positions overnight, you got to be willing to trail things on a 15-minute chart because you're going to get stopped out on your 5-minute charts. So at this time of the day here, and usually I start to switch over to 15-minute charts around 10:30. It's usually when their importance increases and the 5-minute chart importance decreases. So these same extension rules that we're talking about here for the daily chart that we now applied to our 5-minute chart, where we were able to discuss time correction continuation here for the S&P and for the NASDAQ, well, guess what? No surprise, it applies on a 15-minute chart too. And look at where we were at 11 o'clock on the 15-minute chart. What type of candle is this? This is a hammer candle. I wish it was on higher volume. I wish to the Lord Almighty that this was on higher volume, because then this would be a capitulation hammer, which is, I don't like calling bottoms, but that's a potential bottoming signal. Otherwise, this is really just a retracement signal. Even with the volume, it's technically a retracement signal, not a reversal signal, not a bottoming signal. It's a retracement signal, and then again, we can have rules in place for how retracements become reversals. But you got this nice 15-minute candle coming in. No, there's no capitulation today. I saw it in the corner of my eye. Someone asked a question about closing volume. I'll get to it in a bit. So look at the extension on the 15-minute chart. And this is post 11 o'clock, right? And this is the SPYs. The IWM is probably worse. So the SPYs here now are trading at, the low is 375. The ADMA is at 379.50. It's 11 o'clock. We're extended on a 15-minute chart by $4.50. It's significant for the SPYs. So up until that point, this is the best short. You could take a cute little short here. You could take a cute little short here. I didn't like either of these as much, but you could have taken them. They were all called out here in the VTF. I called them out myself since I know it was done. And then this time I said, don't do it. Don't do it. Don't do it. I think this time is different. Why do I think this time is different? Because of a combination of what I'm seeing from the IWM daily chart with what I'm seeing on the 15-minute charts. This potential 15-minute hammer coming in just coupled with massive 15-minute extension for that time of day. So not only am I now not looking for another short, I'm looking for longs. And we called out several of them. One, we called out the Qs here for like 50 cents worth of risk. I apologize, I don't remember which one of the guests, and I keep seeing your name pop up, so I hope you're still here. Called out the Tesla long. This is why I'm looking to build out the community further, is communication from traders like you guys that can help make all of us better. The idea of someone who's in the virtual trading floor should not be just entirely about how much am I to get from it. It should also be how much can I give to it. Both. That's how we make the entire room better. But anyway, I digress. One of you guys called out the relative strength that was then coming into Tesla right here. It was a great call out. Relative strength and relative weakness is one of our key layers of probability. Why do I want to go to Tesla at 11 o'clock as opposed to anything else? Well, because look at what the SPYs and the Qs are doing at 11 o'clock. They're still making lows. Even though we had a good call out in the Qs here at lows, they're still making lows. What's Tesla? Tesla's making a higher low. This is a much higher probability of having a real reversal. This is a much higher probability of giving you really good follow-through. So that was a great call out here. And if we want to be looking at our 15-minute charts, there was an inside 15. And this is what I said you could execute off of. So you had the hammer here, you had the relative strength coming in, you could see that on a 5-minute chart, you had the inside 15. And I don't have time here to give a full class on inside bars in addition to all the other classes that we're kind of doing in today's afternoon meeting, but let's just suffice to say that we use inside candles as an execution strategy, usually with trend, actually. This happens to be a counter trend one, but it's a counter trend inside 15 following a hammer. And that's actually usually when we'll look at inside bars as counter trend trades. So you could have executed through the high of the inside 15 versus the low of the inside 15. It was a decent amount of risk. And I said that. It's like $7 worth of risk. But, I mean, it's Tesla. You know, this is why I don't like trading honestly expensive stocks, even though Tesla's a lot less expensive than it was. It's so much space risk a lot of times. I prefer companies. My sweet spot for trading stocks is like $10 to $150. Anything from like $10, even a little bit more than that, to $150. It's my real sweet spot. This one's a little bit expensive, but you had the relative strength. You had other layers of probability. So this was a great long here. And then and I think I called out a path long also. That was very tight risk versus this low. I think I called it out for about 10 cents risk. Okay, it actually never broke that low. So maybe you're even still in it into the close. So just a whole bunch of now switching to long trade. We're in a two-way market, right? And again, there is a chance because of the big picture. So I always going to start with the big picture. There's a chance based on this big picture that we see a full reversal today. There was a chance that the S&P, that the SPYs closed above 382 today. That we get into this gap in the afternoon. That the MOCs, instead of being 5.5 billion to sell on the MOCs, that there are 5.5 billion to buy as we were already above 382, as we're in the gap, and next thing you know, we're closing at 388. And there's only so many lessons I can give in one afternoon meeting. It's already 5 o'clock. But just to repeat what I was saying earlier, that's the way you make big money. The way you make big money, honestly, is by having profit in the Qs or in Tesla or in Path or in SoFi, any of the longs that we called out at 11 o'clock today, by having profit, putting some of that profit in your pocket on the way up, and giving some of it all the way back. You gotta give some all the way back. It's so important to me. So I spoke to 2 people last week, 2 people who are professional traders in the team who are saying, Derrick, I'm struggling with my reward maximization. The only way you can have real reward maximization is if you say, I got this 25% of my NASDAQ left and I'm giving it all the way back because I'm going to make money no matter what. And I'm not here to make $200. I'm here to make big money. And the only way you're going to make the big money is by capturing the big moves. Let me tell you, anybody who caught this Q low when I called it out, and you held 25% or less, not more, I don't want it to be more, 25% of your position or less, if you held it all the way back from this high at 1235 and then got stopped out on new lows, I commend you. That's the only way. So a couple people I spoke to yesterday, I hope you're listening. That's the only way you will ever make big money in the market, is if you are willing to give back a percentage of your position, 10 to 25% on a counter trend trade, all the way back. Because let me tell you, if you got stopped out on the Qs here at 330 when new lows come in, you still made money as long as you had an okay game plan. If you followed my game plan rules for counter trend trades, and you covered some to take off your risk, and you covered some, we got to go to a 15-minute chart, and you covered some at the 80 MA on the 15, and you covered some into the spike here, and then you get stopped out, you made money on the trade. You're better off giving back 25% and getting stopped out here than you would be if you were a magician of a trader and you knew this is going to be the high and we're not going higher, and you somehow magically sold your entire remaining 25% position at 281. That person made more money today than the person who gave it all the way back. That person is not making more money over the course of his career. The person who's making more money over the course of his career is the person who says, I got 25% of my position left. I'm giving it all the way back to my stop loss. I don't give a hoot I wish I could curse. I'm not allowed to curse in the VTF. Once in a while, I'd like to curse for emphasis, but I'm not allowed. Compliance will start sending me fines, and this market's crazy enough. I don't give a hoot. I'm giving it all the way back to my stop loss. Stop me out. Stop me out. I dare you, market. Stop me out. Because if you can't stop me out, I'm still going to have this stock at 290. And that's when I'm going to make big money. I'm going to make more money by having 25% of my position and catching that next $10. Or catching this move. Or catching this move in March. Right? That's the only way you're going to make really big money. So the only way you're going to make really big money is if you caught the low in March, which we also did as a team, and instead of saying when it was at 325, oh my God, look at me, I'm $5 in the money in the queues, let me get out. He said, hey, I'm going to give $5 on 25% of my position all the way back. Take it from me, I dare you, because I still got it at 370. It's the only way. So again, anybody who took that long here, you gave a percentage of your position all the way back and you got stopped out, congratulations, you did the right thing. It doesn't matter that you would have made more money today if you exited the position here. It doesn't matter. It doesn't matter. You got to put yourself in the position for the bigger money. And again, but it's specifically after you're in a win-win situation. I'm not saying don't take anything off. I'm not saying don't get your risk covered. I'm not saying don't put yourself in a winning position. I'm saying that when you get stopped out at this low, you made money. But you put yourself in the position to make significantly more. And that's all we can do as traders. Your job as a trader is not to make money. That's a result of your job. Your job as a trader is to consistently put yourself in the position to make money over time. That's what your actual job is. I'm going to put myself in the position to make money every single day, every single trade. And then if it stops me out and I had a good game plan and I made or lost nothing, or I made a little bit of money, so it's great. Or if I put myself in the position to make a lot and it actually worked out the way I would like it to in an ideal world, I absolutely crushed it. That is what you got to do. So anyway, that's kind of where our longs came in. And then honestly, the only other trade here was to take the 15-minute equilibrium short off the tail. When this tail came in, I know this is when I had to step away for a little bit today on a meeting. This is a shorting opportunity. And look, guys, you can in this market, what's up, Felipe? You can in this market be long and short at the same time. You know, if you got the Tesla long, and you're saying, oh, look at it, look here, there's a potential short trade in the SPYs and Qs off of this 15-minute correction. Take that also. You get stopped out of this, okay, fine, you lose a couple bucks, but Tesla's paying you. You make money on this because it's just a 15-minute, upside correction. Bear market continues. You give back some money on your Tesla, but you make money on this. I mean, that's trading, right? So that's fine also. And then honestly, from 1 o'clock into the close, I really didn't see much today. We were in this consolidation all day. This is when I don't want to be executing, by the way. Honestly, this is when I don't want to be executing. I don't have an advantage in this price action. We're below the last real pivot high. We're above the last real pivot low. The market's consolidating. We could break up into the close here. We're on some good MOCs because of the downside extension. We could break down into the close here because it's a bear market. No advantage doing anything here on this time of the day. You're just in position management mode. And that's just how it is sometimes. Some days give more opportunities than others. Sometimes, some time is more opportunity than others. Today was actually a good day as far as intraday trading opportunity goes. We were trying our opening longs. Those eventually stopped us out. Then we had our shorts. Then we had our longs at 11. Then you potentially could have had a short here again at 12:30. So there was good opportunity. But and again, to give the Pro Desk a shout out, as a team here, we really did a really good job communicating those trades. What I really want the guests here in the VTF though to take away is not just like, oh hey, like Derrick called out the low in the Qs, like cool. I want you to understand the why, because if I can teach you the why, then I can get what I really want, which is you to be someone who contributes to the team as opposed to someone who just takes from the team. And if you're a newer trader, we all start as takers, and that's fine. But the goal is to learn so well that honestly, you don't need me anymore, but you want to be here anyway, because by that point you've learned, if you're here that long, you've been here for a long time, you're probably not going anywhere. And you want to still get the resources that the team provides, but you don't need me anymore. You're just here because you love it. That's what I want. Let's get you guys to that point. And then you could be just like Felipe, who just dropped in. You know, Felipe here. Felipe started as a professional trader, just out of college. Hired him out of college. Sat on the trading floor with me in New York City back when we had trading floors. Felipe didn't know his left foot from his right foot. This guy didn't know anything his first 6 months. Like it was like, oh my God, is this guy gonna be able to put it together? And now this guy has 6-figure days. So let's go. I think that's all I have for today's afternoon meeting. I hope you guys learned from that. And now I'm going to turn it over to you guys for questions. So what I do here is, thanks, Shrimpy Doodle. So what I do here is I scroll back up into the VTF. So I just kind of need you to give me a moment. I usually scroll back to about 10 after 4 or so, just to see if any questions had come in during the course of my meeting portion that I missed. Where I can answer those questions, and I'll work my way down to anything that was new. Mike B telling me I look like I'm in a hostage situation. Yeah, I'll try to do something about the light under this window. I have a beautiful view here. I can actually see the Freedom Tower out this window. It's pretty cool, and I'm in Long Island here. I'm not in the city. I'm spending part of my time in the city, part of my time in Long Island, and where I really want to be is back in Idaho, but that's gonna probably have to wait a few months. Get through the summer in New York. Bear markets for the media, ain't that the truth? Alright, we got a lot of comments in here. So if I do miss any questions, just copy and paste them to the bottom. I know someone asked me about closing volume. So from PK here, the 8 and 21 as equilibrium, can this be also set as reversion to mean? Yes, it can be set as mean reversion. And the market comes to it, or it comes to the market. Recording is on Derrick the Trader. Heavy volume at the end of the day. So from KG here. Volume is always going to be heaviest on the first bar and the last bar of the day as a general rule. The reason for that is because it settles MOC orders. Let me try to see if I can find an example of something that hasn't traded away. This is a small one, but it just kind of came up here. So you can see IBM here, and it's just the first one I'm seeing, so I'm just going to go with it. IBM had a net sell imbalance into the close of 30,000 shares. Again, it's not big for a company like IBM. So the market on close orders are settled on the closing print. This, I think, was the closing print right here, 43,000 shares. And it takes place as like an out-of-market print at what is the closing price, 135.11. It took place at 135.11. So that's your closing print settles the market on close imbalance, and that closing print is then always going to be sizable. And then what that does is it increases the volume on that bar. So you don't want to overread the volume. The way you read volume is honestly, the way you read volume properly is always on a relative basis. So most of the time you're looking at the volume on whatever your time frame is. Right now it's a 5-minute chart. You're looking at the volume relative, right? It's like, oh, okay, a little volume uptick here on this bar, like nothing crazy. Like, oh, look, volume picked up on this, sell-off that it had here at 10:30. You also want to see how your average volume looks, and you can do this just by eyeballing it versus like the previous day. Like, oh, does it look like we're having a higher volume day, a lower volume day? And then again, the thing about the opening and closing candle is they're always going to have higher volume relative to the rest of the market, unless something major is happening. You know you got an important candle, by the way, if it's 10:30 and you're seeing a 5-minute bar that's higher than the opening bar. You know it's an important candle. Because if you got candles doing higher volume than the opening and closing candles, it's significant. But again, so these are always going to be higher. So the way that you would want to check them is relative to other ones. So you can see here, like our closing candle today of 270,000 shares for IBM, it's not significant. It's the same as it was on Friday. It's roughly the same as it was on Thursday, which is a little bit more than it was on Wednesday. There's nothing super significant kind of going on here. So actually the volume on the opening and closing candle can be hard to read because it's disguised by the opening print and closing print, which is settling the opening and closing imbalances. So the way you want to try to do it, again, is just going to be based on previous opening candles or previous closing candles, and you can just look at it kind of on a relative basis. So I hope that helps, and no, that's, you know, capitulation. Capitulation will be when you see a 5-minute candle at 10:45 that's 2 or 3 times the opening bar. That as the market's selling off heavily into it. That's what capitulation may look like. A lot violation goes. Did someone say fines? Awesome Trader Mike. That's one of the things I'm personally good at. I'm really good at being greedy after my risk is covered. I love it. I love being greedy after my risk is covered. And I'm actually very risk averse until I'm in a win-win situation. But once my risk is covered and I feel like I'm in that win-win situation, that's when I get super greedy. What was the class you mentioned that will be delivered? You mentioned a few minutes back, and when is it? I mentioned a class on gaps, and I mentioned a class on game planning. I'm not sure off the top of my head which day is which. The trader counselors here can probably help you with that, because there is a schedule laid out for me, but I don't have it memorized. But I'm going to be doing classes of my training program every Wednesday for 4 weeks after this open house for people who opt into the boot camp stuff. I think that's what we're calling it, boot camp. And then you're going to get access to additional classes that are going to be pre-recorded also. So either the gap class or the game planning class, I think, is what you're referencing. Again, thank you for the compliment there, Shrimpy Doodle. Igor, what do I start with to get involved in day trading for a living? Okay, we're really at 101 here. I think that a great combination, to be totally honest with you, and I'm obviously biased because I put it together myself, but it's from, 10 years of training traders at this point. I've been managing professional traders for, I guess, almost 10 years, 9 years. I think if you combine the virtual trading floor, the morning and afternoon meeting, with my training program classes that I'm going to be doing in this boot camp, it's a great starting process. It's a little bit tricky if you know absolutely nothing about nothing to immediately jump into our morning and afternoon meeting. If you ask questions, I'm happy to break things down to the basics for you. It's a lot of what I did today. This afternoon meeting, we really got down to the basics. But if you've done absolutely nothing ever, you got to learn what a candlestick is. You got to learn what support and resistance is. So if you go through my training program classes and you combine them with the morning and afternoon meetings from the virtual trading floor, I think that's the best way to get started and work your way through the learning curve. So I hope you choose to do that. Dittal, can you go through an explanation of the other 2 prongs? I don't know what you're referencing when you say 2 prongs. If you want to repost your question into the VTF with a little more detail on what you mean by the prongs, I'm not sure if you're talking about the volume that I just discussed or what. I'm happy to talk about it in more detail. From Eddie here. May I ask your opinion on consumer discretionary? They're rocked. Whether you would trade on stocks such as Nike, Home Depots, and Lowe's. So trading consumer discretionary is not my favorite sector, honestly, to trade roughly. I love Nike as a company, though. Absolutely love it. Home Depot just had so much forward earnings come in for people redesigning their houses during COVID, that's hurting them a little bit also. I mean, broadly, when the market's expecting a recession, consumer discretionary is viewed as, unnecessary spending as opposed to consumer staples. So these get hit hard, right? So I think we're seeing like consumer discretionary in certain aspects of it is one of the more beaten up sectors I think in the entire market right now. So if you want a broad opinion on consumer discretionary, then I need to know what the recession is going to look like. If a recession is going to happen, which again, Fed officials are still saying that the soft landing is a possibility. If a recession is going to happen, and again, everyone is just talking about a recession like it's a very binary thing. It's not. A recession can have a lot of different faces to it. My personal viewpoint, my personal thought process that I've been talking about is, what if we get the definition of a recession, right, which just means 2 quarters in a row slowing GDP. What if we get a technical definition of a recession, but we don't get, for example, some of the really bad things that usually come with it, such as massive layoffs, right? You look at the employment situation in the United States right now, and my data here is probably getting a little bit old, but maybe a month or so ago, we were looking at 12 million open jobs and 6 million job seekers. And we're already seeing all over the place that's got to be slowing down, right? We're seeing it from Tesla, we're seeing it from Snap, we're seeing it from, just been, company after company after company. If they're not announcing outright layoffs and hiring freezes, they're announcing, hiring slowdowns. But what does that mean? I looked at some data a few weeks ago that actually said it would be bullish if open jobs could go from 12 million to below 10 million. You still got 6 million job seekers. It's still a good job market if you're out there looking for a job. If you're, if there's a job and a half for every person who's looking for jobs, as opposed to right now where there's 2. But that would actually be bullish for the market. So what I'm trying to get across here is, what if we see a recession, a paper recession, if you will, where no one loses their job, where there's not massive layoffs, where there's not more people looking for jobs than there are jobs that are out there. So people still have income coming in. People are still able to spend. If we get that type of recession, let alone, and that's probably a little bit more bearish, honestly, than soft landing that the Fed's talking about. If we get a soft landing, which I think is a little lower probability, or if we get that type of recession that I'm describing here, I think aspects of the market are fundamentally cheap. I really do. But it doesn't mean I can just buy them, right? It doesn't mean I can just buy them. If I'm investing, I can buy them. If I'm a trader, I can't buy them. I need the technical signal to confirm the thesis. Because even if I'm right, prices could still go down. Even if I think that things are fundamentally cheap broadly in a lot of aspects right now, I think that we're fundamentally cheap broadly in the IWM. I think that we're fundamentally cheap broadly for certain FANG names, honestly, like Apple, even as it's had multiple contraction. I think that we're fundamentally cheap in the biotech sector broadly. We can still go down even if I'm right and the market just gets cheaper because of the fear that's out there. Or the bad recession scenarios, we really lose the E part of the PE multiple and earnings begin to deteriorate. That's how you see lower prices. So again, you want my opinion on consumer discretionary? I don't follow the sector as closely as others, but we're probably getting cheap here, provided that we don't go into a bad recession. But I just need the market to know this. Hope it helps. Hope it helps, Eddie. From Jerry here. Do you do anything in the after hours pre-market setup for the day? Oh yeah. No. Pre-market is the most important. So I said this morning. I'll repeat it for people who may not have been here at 8:45 this morning. The most important part of my day is 7:30 to 9 o'clock. That's the most important part of my day. And I know the emails are like, hey, come join the virtual trading floor at 8:45 or 9 a.m. And you can do that if you want, or if you got a tighter schedule. You'll still be able to learn. You'll still be able to follow along with some of the stuff that we're doing. But I think if you really want to be a good trader, you got to be in here 7:30 to 8 a.m. We start getting our research information into the virtual trading floor at 7:30, typically. Pat posts every company that reported earnings, every company that got upgraded, downgraded, other types of research, macro news. Then Pat posts a fantastic morning note at 8:30 every day. You can see it in the alert section here in the VTF. It's about market dynamics. It's money. It's gold. Pat's note alone is worth the price of admission here because this VTF is ridiculously cheap. I really got to get that changed. It's going to get changed. I'm sorry. It's going to get changed. I don't care if less people come in, to be honest. But this price is ridiculous for the just the news and the option flow and Pat's note. It's like everything else we do here is for free, and I don't like working for free. Anyway. So you got. I really recommend that people are here early. My best trades always come from my pre-market research. The research I do, the game planning I do, all the preparation I do up to the morning meeting at 9 a.m. That's where my best trades come from. The random stuff that happens intraday, can make some money for yourself, that's not where I make bigger money. Bigger money has been thought out. It's premeditated. After hours is important too. This is where we do our learning. In the afternoon meeting. This is where you guys get to ask your questions. I do this every day. And this isn't special because you guys are here. It's maybe going a little bit longer because you guys are here. But I do this every day. This is where the improvement's made. And when the afternoon meeting is done, you still shouldn't be done. You should review every trade that you took. You should journal every trade that you took. You should find a partner to review every trade that you took with. If you're a new trader and you want to work your way through this really steep learning curve that we have in this business, the way to do it, and I guess, I actually have a cool thing here, I think. Did that work? Ooh, look at that. I've never done that before. This is part of my new technology. Though the light's not great in here. I'll try to work on that for tomorrow. If you're a new trader and you're trying to work your way through the learning curve in this business, the way to do it is not to work from 9:30 to 4. Successful trading is like being successful at sports. These are performance-based activities. If you want to be the best basketball player in the world, are you only going to show up for the games? No. You're going to show up for practice. You're going to get out there. You're going to play on your own. You're going to get out there. You're going to shoot on your own. You're going to get out there and you're going to do mental exercises. You're going to get out there. You're going to go over the things that your coach taught you. So if you just trade from 9:30 to 4, okay, fine. You get better. But if we review everything in the afternoon meeting, that's a second experience of it. If you review everything again for a trading journal, it's a third experience of it. If you review everything again with a partner, it's a fourth experience of it. If you review everything again because you do meditation and visualization exercises, it's a fifth experience of it. Guess what? You just took one day and you turned it into a week of experience. When I was a new trader, I was the hardest working person in the whole company. I was at the office from 7 a.m. to 7 p.m. every single day. And to this day, I'm probably still one of the more harder working people at the company. And that's more because I've got a lot of responsibilities at T3 in addition to my own trading, in addition to the virtual trading floor. But that's how success is really made here. I'm sorry. I'm not here. Here's the bad news, guys. I'm not here with a get-rich-quick scheme. I'm not here to say, hey, come in from 9:30 to 9:40 every day, and I'll make you rich, and I make $1 billion, and you make $1 billion. Everybody makes $1 billion. What do you mean you don't make $1 billion? I don't do that. As a matter of fact, I'm not even allowed to talk about my P&L. Compliance would have a fit, and that's because I'm regulated. Which, to get in, not to get too deep into it, I highly recommend that you are only involved with people who are regulated because I'm under scrutiny all the time. Like if I said to you guys that I was in a position that I wasn't in, I would get in regulatory trouble from FINRA. I could lose my licenses, so I can't do that. So anyway, bit of a rant there. Hope it helps, Jerry. From Ellie, I think it is. Ellie? I have been doing somewhat similar to what you said. and hearing it from you gave it more conviction. Holding a runner or 25% of my position until I'm stopped out. What I do is until it retraces around 50%. I move my stop up if it's nice on runners. Perfect. I have very specific trading rules on trailing stops, which I get into in my game planning class. Maybe we'll chat about it in an afternoon meeting one day at some point also. Can you show your open positions with dates and times filled? So I actually asked them to take that out of the VTF. I know you can have timestamps. I trade too much. And the problem, and the reason why, it's a twofold reason why. One is I execute a lot, like a lot. And two is, if you see it, you don't see how much, you don't see the size. Like, what if I have 10,000 shares and I sell 100 shares and it's just timestamped as a sell? With that's not going to do anybody any favors. So I specifically asked them to take it out. I think it still blinks, like green and red or something on buys and sells or something. I actually, I don't know. I don't necessarily recommend that people look at the position window just because I don't think it's going to be tremendously helpful. I mean, it shows you what I'm in, but I'm communicating what I'm doing. That's where you're going to get the most amount of benefit, is I'm trying to communicate what I'm doing. From Igor here, I was a broker for 10 years, still trading for myself, but not successful. Made a lot of money on paper, but now lost almost all of it because I didn't sell. You got to trail. Trim and trail is the same thing that we use. When you're in the win-win situation, on a day like today, maybe you want to give it all the way back, but you don't give it all the way back. You want to have specific rules to be able to raise your stop consistently over time. So that way, you're still putting yourself in the position to let your winner ride for as long as it wants to. I held a Microsoft swing position for like 7 years because it never stopped me out based on my rules. I got in Microsoft, I think, as a swing position when Satya Nadella took over as CEO in like 2014 when it broke out of a 12-year breakout, and then I got stopped out in COVID. I caught the entire run-up because it never broke my trailing rules. But I wasn't going to give it back to $40 either. I just trailed it all the way up until it eventually took me out, I think around 161 or whatever. So, game planning class. Oh, I just realized I didn't have my charts up. I was just trying to show the Microsoft chart. Sorry. Like I said, new technology, but it's a good thing. Cool. Next here from Rob. Why do you not use the 50 on the 5-minute chart? I think that the time frame's too big. How many 5-minute bars are there in a day? I don't know the answer to that question. How many 5-minute bars are there in a day? What do we have? How many hours is the market open in a day? I don't want to figure this out right now. 1, 2, 3, 4, 5, 6. 6.5 hours by 5-minute bars. I don't know. I don't find that to be tremendously effective for me personally. But if you use it and it works for you, I support it. You know, again, the way is not necessarily my way. I hope you guys can learn a lot from me, but you can learn a lot from other people here who look at different things. Like Pat uses Ichimoto clouds on his morning note. I can't tell you what an Ichimoto cloud is. Honestly, I can tell you a bit about what Bollinger Bands are, even though I don't use them. Ichimoto clouds, I don't even understand how it's formed. But he'll provide information. Oh, we're at the top of the Ichimoto cloud, so look for extra layer of probability for longs or shorts or whatever. Yeah, reach out to info@t3live.com for more questions about getting involved with us. Awesome, Trader Mike. I am dealing with putting this brain thing on in the mornings now, which is taking me a little bit of time. So that's a new thing also, where I gotta figure out, because it took away a little bit of time from my morning research today, which wasn't. I still accomplished everything I needed to, but it took a little more away from the time that I wanted to, and they want me to put it back on every day. I took it off for the afternoon meeting, and then I had to wash my hair out because it was full of this white stuff that lets it read my brain for the trading algorithm. What a world. I remember when I was a new trader, I did a lot more scalping, and I only day traded, and it was all about speed, and it was all about tape reading. It was just a different market environment. The stuff I did back then simply doesn't work now. I don't even teach it anymore. But it's why I'm actually a really good tape reader, is because of the market environment that I kind of grew up in, if you will. And I remember thinking, like, man, one thing that limits my P&L is that I actually have to physically press the button. Like, I wish I had a thing where I could just have my brain do the execution. And now, for the first day ever, I put a thing on my brain that could potentially have a black box behind it that will do that, basically. So cool. So cool. Will you be discussing your trading method and analysis to decide when you want to make a trade? I think I've been doing that all day, so I hope you've been here, and I'm going to continue to do it, absolutely. So if you missed anything today, then stick with it. I love the quote there, Shrimpy Doodle. Shrimpy Doodle. I think that is one of the best things to master, knowing how to trail properly. Yeah, I have specific rules for it. Everything has to be consistent. I don't move my stops based on percentage points. So here I'll just get into it real briefly. I'm not going to get into the specifics of my system. But I know that, like, Thinkorswim, as an example, has an order type, because people ask me about it sometimes when they join T3. I'm like, hey, I use this order type in Thinkorswim, and I want to be able to use it at T3, and we actually don't support that order type. And basically what it does is it trails your stop by a percentage basis or a dollar amount. So you can plug it in to trail by 3% or whatever. I hate that idea. Because it's subjective to me. Why is a specific percentage trailing stop important to the marketplace? 5% or 3% or 25% or whatever you're choosing, or 50 cents or 10 cents. What makes that important in the market? It's not important in the market. It's important to you. I don't want to make decisions that are important to you or important to me. I want to make decisions that the market is telling me are important. I let the market dictate what I do. I don't dictate the market. So I have 3 rules for trailing that I'm not going to get into in today's afternoon meeting, because it's one of my training program classes, and it's an hour-and-a-half class or whatever by itself, that lets me trail my stops based on the information that the market provides. Yeah, so the remaining stock I'm looking to trail? Yes, I'm looking to trail. Again, if it's counter trend, you can't trail it right away because you need the trend to kind of reverse in order to be able to trail. If it's with trend, you can start trailing it right away. So very broadly, I categorize trades, to take a step back, into 2 categories. There are trades that are with trend, and there are trades that are counter trend. Trades that are with trend, you can basically begin to trail right away. Trades that are counter trend, you technically need a reversal in order to actually be able to trail on that time frame. And then I meant to get into it. There's so many lessons from today's market, but we had a 5-minute reversal today that was a 15-minute retracement. That was just a 15-minute retracement. And I spoke about it a lot during the day, and now I'm getting tired, so I'm not going to do it too much right now. But a 5-minute reversal, in order for a full market reversal to happen, your 5-minute reversal is to become a 15-minute reversal. Your 15-minute reversal is to become an hourly reversal. Your hourly reversal is to become a daily reversal. And that's a lot of work. So that's why picking tops and bottoms of the market is so difficult. It's like, all right, we got the 5-minute reversal, and the 15 minutes just a retracement. Now we're at new lows, right? So definitely counter trend trades in general, I prefer with trend trades, but in periods of market extremes, we're in a period of market extreme right now because of how oversold we are and how extended we are. That's when I become more interested in counter trend trades, like the long call outs from today, and honestly less interested in with trend trades. Hope that helps. Shai asking me tape reading doesn't work. No, tape reading works, but it's evolved dramatically from how it used to be. When I was a new trader, if you gave me a choice He said, Derrick, you can either have tape and no charts or charts and no tape. I always said, take my charts away. I don't need them. I don't need them to make money. It is now entirely different. I've actually pared back some of my professional market data. I used to pay for depth on everything. I don't anymore. It's not that important to me. In this market, and it's been this way for honestly, it's probably been this way for 9 or 10 years now. The charts are significantly more important than tape. And honestly, most of what you think you see in the tape is noise. And I hate saying this because I'm actually a really good tape reader. It's a skill that I'm not ashamed to admit that I have. I'm a really good tape reader. And at the same time as I say that, I'm telling you it's not that important anymore. It's important in certain situations. It's important when you're trading an IPO. It's important when you're trading a stock on news. It's important if you're trading after hours on an earnings report. And it's important for execution. It's important for execution for trades because if there's a massive refreshing buyer that's right in front of me, I don't want to be sitting behind it. And it is a hard skill to acquire. I was able to acquire the tape reading skill because when I was a brand new trader, I sat around people who are old school, really good traders, and I just listened to them and asked them questions. And that was it. But the skills, it's just not important. The charts are so much more important now. Focus on your charts first. If you're a newer trader, focus on your charts first. Add on tape reading as a supplementary skill at some point down the road to help you with execution in special situations. You've learned that your hyper scalps have become better. Higher probability doesn't necessarily mean higher profitability. I used to, in an uptrending market that was very volatile, and I guess this market, so scalping requires high degrees of volatility. Let me start by saying that. So honestly, 2022, I just haven't reverted back to it. Might be a better environment here for a lot more scalping trades. This actually might be a better market environment for scalping trades right now in 2022 than it has been in any other time in the last 10 years. When I was coming up and doing a lot of that, we're talking 2010, 2011, 2012, pre-2013. 2013 is where it really started to change. 2010, 2011, 2012, the market was having the financial crisis hangover. So there was low liquidity, kind of like now. There was a lot of volatility, kind of like now. And I did a lot of counter-trend scalping. And it was based on tape. It was, size trading and steppers and all this stuff that I honestly don't even teach anymore. And it worked. If you were disciplined, it worked. And then around 2013, when the vol dried up and the market direction really resumed to the upside, it didn't. And that was when I went into the first slump of my trading career. And I changed and I adjusted, and I'm still here today. Yes, Bob, that's what I'm talking about. That's what I'm looking to trail. And I'm doing it based on specific trailing rules. 3 specific trailing rules that I have. All right, gang. It's 5:40. We had an hour and a half plus afternoon meeting here. But happy to do it if you're learning. If everybody's learning, I don't mind putting the work in. After a while, I start to lose my voice and get a little tired. But if everybody's learning, let's do it. Let's do it. Really hope you guys are again, the big takeaway, and this is why you guys should keep coming back after this week, following people on trades. It's, it's taking the tool set for yourself, right? And really learning the process so you can do it yourself. And that's why you want to stick with this. Have a great night, everybody. See you bright and early tomorrow morning.